Good morning, ladies and gentlemen. Thank you very much for the opportunity. I was given the title Providing Income During Sustained, I assume, Market Volatility. So two key words here, income and volatility. So we're going to be focusing on today. If I may start with income, as you know, in the interest-bearing space, we need to invest in instruments that pay an interest or deliver on income so that we can sort of manage funds according to mandate. And there's a clear link between all these instruments and the level and direction of interest rates. If you look at this chart, we're showing the prime overdraft rate and headline CPI going back to January 1960. And two things I want to highlight. One, since the mid or end, the late 1990s, clear downward trend in the green line, i.e. headline CPI. And that was intended. It's also a result of global forces. As we all know, inflation sort of globally sort of trended lower over time. And of course, locally, independent central bank with a mandate to manage inflation lower, create price stability over time. So you can clearly see that. It's great news. Low inflation is good news. I mean, one of our two sort of big enemies in the interest-bearing space is inflation because it eats into potential returns, and of course the other one is default. So it's not about just COVID. It's not about what happened last year. Yes, interest rates may sort of like trend higher again over the next 12, 18 months, but do not expect interest rates to go back to the levels we've seen 2 decades ago or so. Which takes us to the funds. I'm just showing 3 of the interest-bearing funds we're managing on behalf of the Old Mutual Unit Trust Company. And just to give you a feel for the volatility and the risk profile of these funds, the first fund is the Old Mutual Money Market Fund, going back to 1998. In terms of positive months, you do not want a money market fund to generate any negative months in terms of absolute return, and that's exactly what we've managed over time. The tracking area in terms of its performance quite low, less than 1%. Let's add a bit of more risk because we want to generate a little bit more income, and let's go to the income fund, allow to sort of move out onto the curve to take on a little bit of extra duration risk, a little bit of more credit risk as well. So of course you would expect positive months to be lower than 100%, but in the end we still endeavor to limit negative months to no more than 2 consecutive negative months, and of course you would expect the tracking area to be higher as well. And on the right hand side, that's the bond fund. Lots more risk. It's allowed to take on lots more duration, etc., etc. So with that, you would expect some sort of additional sort of like tracking area in terms of potential returns and return volatility as well, of course, over time. The important thing here is also to look at that. You do get something in return in terms of returns. Money market funds performance since 1998 average around 8.2%. The Old Mutual Income Fund, going back to 1989, just over 11%. And then, of course, the Old Mutual Bond Fund, going back to 1994, just under 12%. So how do we do that? On the right-hand side, what I'm showing is the yield curve or the term structure of interest rates. Just briefly again, what we're showing there is like the term of instruments that we can invest in, from 3-month money market rates out to the longest dated fixed rate nominal bond in South Africa, the R2048, with a term to maturity of about 27 years. All these instruments trade at a market yield, and that's exactly what we're showing on this curve, with the 3-month JIBAR rate trading at the level just below 4%, and a 27-year bond at this point trading at around 11.5%. And that's your term structure of interest rates, or also your yield curve. So where do we plot these 3 funds in terms of that? Money market fund with a weighted average modified duration of about 0.2, yield of just over 4%, it's not allowed to go out further than 13 months. It's capped. In a way, it's probably comparable to an Italian scooter. It can't go very fast. It will get you somewhere from point A to point B, but you're not allowed to go fast. And that's exactly how it's designed and supposed to be. Adding a bit more risk to enable us to sort of add more returns and income over time is the the income fund with, again, a slightly higher modified duration, at the moment 1.8, with a yield of 5.8. The reason why the yield is higher is because the income fund is allowed to venture out onto the yield curve with an important difference. It's not supposed to go on average to a modified duration, weighted modified duration higher than 2. So yes, I can go and buy a 27-year bond, but I'm limited in terms of how much I can add into the fund because of this duration cap. It's important because there's a reason for that. We need to put a cap on things in terms of interest rate risk to manage the interest rate volatility of the fund, to align it with its mandate and the way it's supposed to respond. On the other side of this coin, Papa Bear, the old mutual bond fund, a much higher modified duration, and of course with that also a much higher yield, weighted average yield, because it's allowed to venture out onto the curve. Sure, there's some limitation in terms of the duration, but it's still high at 1 plus the duration of the all bond index, which is 6.4, which will take the fund to about 7.4. So there's lots more risk in that. So just to maybe give you a feel for volatility, because this is important, the all bond index, it sort of like goes out from 1 year out to 27 years at this point. We break it down into maturity bands, 1, 2, 3, 12 plus, etc. And I'm only going to focus on the two extreme legs of it, 1, 2, 3, the green line, and of course the longer dated, showing rolling 1 year returns for those maturity buckets. Obviously, there are bonds included in those maturity buckets, and that's where we sort of get the returns from. Green line, as you would expect, shorter dated, lower duration, sort of like still moving. There's still some volatility, but if you compare that to the longer dated maturity bands, a lot less, both in terms of bull markets and, of course, bear markets as well. That's important. We need to consider those things when we look at funds and how funds are invested. Does it in the end generate enough sort of returns? Yes, you need time, you need patience, you don't want to sort of like panic. If you don't, over this period since 99, it made sense for you to be invested in longer dated bonds because it outperformed the short end, obviously with higher volatility, and more importantly, it managed to outperform average inflation over this period, around about 6% by a significant amount. How do we pull this through into the three funds again? Again, I standardized sort of like the time period from January 2000 to June 2021. And here, clearly, an upward trend in returns out to the bond fund. But with that, with the higher returns for the bond fund, you have a bigger variance between your maximum and minimum points in terms of total return. And as you would expect in terms of money market funds, much smaller variance. And that's the sort of reduced or lower volatility. All three generate income, but it comes with a higher level of return volatility because of where it's mandated to invest. And this is also important in terms of max returns. It goes back to 2000. The first slide I showed in terms of interest rate levels, don't expect us to go back to the bad old days of higher inflation, higher interest rates. You need to manage those expectations as well. If interest rates are going to be lower structurally over time, you would expect income to be lower, and the money market fund obviously will be impacted by it to a bigger extent. Looking at 5-year rolling returns, again the three funds going back to 2006. See, look at that. I mean, all of them follow the sort of interest rate cycle. But again, money market fund because of its mandate, smoother, a bit more volatile for the income fund, and not nearly as volatile as the bond fund. Again, all three of them generate income. All three of them will follow the interest rate cycle, but with different return volatility profiles because of the fact that they invested or allowed to invest in different parts of the yield curve. I think it's also important, we've been through a very volatile period on the back of COVID, to again illustrate the impact of events and how we manage our funds going through those events. On the left-hand side, Nenegate, remember December 2015. On the right-hand side, last year's COVID crisis, the first half of last year, second quarter in particular. And again, three funds. At the point where we have the sort of like impact on markets as a result of the crisis, Nenegate in this case, you would expect bond yields to spike, the price of those bonds to drop, and the return of the bond fund to go much lower than any of the other two funds. Money market, in this case, doing best. And that's why people tend to flee into money market funds during periods of these sort of like disruptive events, because they're looking for protection. But you've got to be careful, because in the end, you need to look at your longer term sort of outcomes as well. In both cases, the income fund managed to sort of recover the underperformance relative to money market fairly quickly. It took a bit longer for the bond fund, and obviously with more volatility, but you need to sort of like understand this dynamic as well. Do not panic. It's not always a good thing to panic. How do we look at life, and how do we sort of like the investment life, and how do we manage these funds? Apart from the sort of normal top-down approach where we look at macroeconomic variables that will include economic growth, inflation, the impact on monetary policy, both globally and locally, and of course the fiscal situation, to get to a sort of theme and understanding of the big picture, mostly qualitative, but also on a quantitative basis. We try to match that top-down approach with a bottom-up sort of like analysis, mostly quantitative, where we will do all sorts of things in terms of modeling, fair value estimates, etc., but also stock picking. And it's important because we need to do this to get the right stock selection for the different mandates, considering the risk-return profile of those mandates. And I'm not going to go through this in any detail, but there are a few things that we would look at. I'm just going to focus on one or two of them. One is coupon. As you know, any bond is issued trades at the market yield, but at the time of issue, it was issued with a fixed coupon rate. In this case, let's look at the 186. It was issued way back in the 1980s when interest rates were quite high, with high inflation, high sort of like bank rate. It was issued at the yield of, it was trading at a yield of around 10.5. It was probably issued at par, and that's where it got its high coupon rate of 10.5%. Since then, interest rates are lower. It's sort of declined to lower levels. The market rate is 7.5%, a lower duration of 4.2. But the important thing here is that if you buy that 186 at the market yield of 7.5%, you're going to get paid that coupon of 10.5 per annum. It's important to sort of consider those sort of things. So you can't just look at market yield. If you look at, for instance, the R2048, a 27-year bond, it trades at a yield, market yield of, in this case, about 10.7. The coupon is only 8.8. So you have to consider both those things and adjust for that. And that's what we tend to do when we do stock picking as well. So for an income type fund, I would like to sort of focus on this. Score of 12 is high. 1 is low. Clearly, the coupon year scores higher than what the coupon would be scoring in a 10-year or the 27-year bond. And the other thing that we would look at, and I'm not going to ignore the other things, is like base accrual. This bit here. What does that mean? Well, base accrual basically refers to the market yield at which you are buying this bond. You would expect the carry, is the other word that we use for this, for the 27-year at 10.7 to be much more attractive than a 7.5 for the 186, clearly. However, you need to consider the risk that comes with that. The 2048 is issued is trading at 10.7%, but with a modified duration of 8.7. It's a 27-year bond. Its modified duration will be longer. If something goes wrong, the price drop will be significantly more than the price drop of the shorter dated 186 with a modified duration of only 4.2. We need to adjust for that, and that's why we call it base accrual per unit modified duration. We adjust for that. So in the end, if we consider the two and we weigh it, the 186 actually scores better than the long-dated bond at a higher market yield. And that's what that's the way we sort of would consider risk for our funds, in particular for a more risk-averse fund like the income fund. So it's not just me who are making these calls. At Future Growth, we've got like close to 50 investment professionals. We all be looking at these things. We all have a role to play, both qualitative, quantitative, be it interest rates, be it credit, and of course a support team that takes our sort of employment count to around 100. That will sort of assist us in sort of managing these funds, including compliance and other functions. So it's important to consider those sort of things, and that's exactly what we try and do in terms of managing these funds. So in summary, the level of interest rates is structurally lower. Sure, we're going to have cycles. As I said, we probably would expect the central bank to start sort of like tightening monetary policy, hiking rates the next 12, 18 months at a slow pace for a number of reasons. But the point here is that interest rates are lower compared to 10, 15, 20 years ago. It will impact money market funds more so than other funds because it's limited in terms of the term risk it can take. You need to consider that. You need to think about those sort of things. All interest-bearing funds deliver income, be it money market, income, bond, but with a significant risk variance. Know your fund, know your fact sheets, read those things, try and dive into the detail as well. All this is by design and is always aligned with fund mandate. And I mean, the second slide I show data that for those funds that goes back decades, in some cases more than 3 decades, the income fund, going through different cycles, being exposed to different crisis periods, and the proof is in the pudding. It was designed like that, and it behaved like it's been designed. So we're not going to style it. It is not going to be any sort of style drift. The risk-return profile of funds are consistent even in the face of disruptive events. You need to, it's almost like mountain biking, going down single track at speed. I'm told by my friends who go much, much faster that I need to trust my bike more and just let go of the brakes. I'm not there yet. I'm probably never going to be there, but you need to sort of think about that when you look at these funds. Know the risk profile of the funds, know where it's allowed to invest, know what it's allowed to do, and then trust those funds to take you through those crisis periods as well. Timing fund entry exit during bouts of market weakness is hard and risky. I'm not saying not to do it. It's not my place. But one's got to be very careful when you do that. There's risk attached to that. And then, of course, lastly, our fund management is supported by a large, hand-picked, well-qualified future growth team. In particular, we like to sort of like state fact that we do grow our own trees. We do sort of like take younger people from varsity, fresh minds, well qualified, really eager, skin in the game because they do own future growth shares, which they paid for themselves. By the way, we all do, so we all have skin in the game, and we're very focused on delivering on mandate and risk profile of the funds. Thank you very much.